Have you ever wondered how to play the stock market and study stocks to be successful? It's a question that's crossed many a mind, and today we aim to shed some light on this intriguing topic. At its core, stock trading is the process of buying and selling shares of public companies with the objective of making a profit. It's a world where information is king, and making informed decisions can potentially lead to substantial financial gains. But fair warning, it's not all sunshine and rainbows. Stock trading also comes with its share of risks and uncertainties. It's a balancing act, requiring a mix of knowledge, intuition, and a penchant for risk-taking. But fear not, for every successful trader started somewhere, and so can you. Understanding the stock market isn't something that happens overnight, but with a bit of dedication and the right knowledge, you can make informed decisions that could potentially lead to financial success. Before you can start trading, it's important to understand the basics of the stock market. When you buy a stock, you're buying a piece of a company. This makes you a shareholder, giving you a claim on part of the company's assets and earnings. Stocks are also known as equities or shares, and they represent fractional ownership in a corporation. Now, you might wonder how stock prices are determined. It's a process that happens in the stock exchange, where buyers and sellers meet to trade stocks. The price of a stock is primarily determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if there are more sellers than buyers, the price goes down. Stock prices can also be influenced by a company's financial performance, economic factors, and market sentiment. For example, if a company reports higher than expected earnings, its stock price may go up. On the other hand, if there's a recession or negative news about the company, the stock price may go down. Let's delve a bit deeper and talk about the difference between long-term investing and short-term trading. Long-term investing involves buying and holding stocks for several years with the expectation that they will grow in value over time. This strategy is based on the idea that in the long run, financial markets provide a good rate of return despite periods of volatility or decline. On the other hand, short-term trading, also known as day trading, involves buying and selling stocks within a short time frame, often within a day. The goal here is to take advantage of small, short-term price fluctuations. So, to sum it up, a stock is a share in the ownership of a company, and its price is determined by supply and demand in the stock market. Long-term investing involves buying and holding stocks for a long period, while short-term trading involves taking advantage of small price fluctuations. Now that you understand the basics, you're one step closer to making your first trade. Research and analysis are key when it comes to successful stock trading. Diving into the world of stocks without thorough research is like trying to navigate a stormy sea without a compass. It's not just about picking a stock because it's trending. It's about digging deep into the financial health and prospects of the company behind the stock. When we talk about researching a company, we're looking at its fundamentals. This includes understanding the company's business model, the industry it operates in, and its competitive position. It's also crucial to consider the company's leadership and their strategic vision for the future. Are there any new products or services on the horizon? How does the company plan to grow and stay competitive in the coming years? Next, we have to analyze the company's financial statements. This involves looking at the income statement, balance sheet, and cash flow statement. From these, we can glean valuable insights about the company's profitability, debt levels, and overall financial health. Key ratios such as the price-to-earnings ratio, debt-to-equity ratio, and return on equity can help us compare the company's performance against its peers. Lastly, technical analysis is another crucial tool in a trader's arsenal. Unlike fundamental analysis, which looks at a company's intrinsic value, technical analysis focuses on price trends and trading volumes. By studying charts and patterns, traders can predict future price movements and make informed trading decisions. For instance, if a stock's price has been consistently rising for some time, it might be on an upward trend, which could signal a good buying opportunity. Remember, there's no surefire formula for success in the stock market. Every trader has their own approach and strategy, shaped by their risk tolerance and investment goals. But no matter your approach, one thing is certain. The more research and analysis you do, the more informed your trading decisions will be. Remember, the more research and analysis you do, the more informed your trading decisions will be. Having a clear trading strategy is crucial for success in the stock market. While the stock market may seem like a giant roulette wheel at times, it's not purely a game of chance. Success in trading is often a result of well-thought-out strategies. Let's delve into a few of them. One popular approach is value investing. This strategy is all about bargain hunting. Value investors seek out stocks of companies that they believe the market has undervalued. They're essentially looking for deals, stocks they believe are worth more than their current price. It's like finding a designer handbag at a discount store. You're getting more bang for your buck. Then we have growth investing. Growth investors are on the lookout for companies that display signs of above-average growth through revenues or robust earnings, even if the share price appears expensive in terms of metrics like price-to-earnings ratio. They're less concerned with the stock's current price, as they believe the company's long-term growth potential will, in time, translate into an increasing stock price. Lastly, there's day trading. This strategy involves buying and selling stocks within a single trading day. Day traders aim to make profit from short-term price fluctuations. It's fast-paced and could be likened to a high-stakes game of musical chairs. When the music stops, you don't want to be the one left standing. Now, it's essential to remember that every trading strategy should be tailored to your personal financial goals and risk tolerance. Are you investing for long-term wealth, a comfortable retirement, or a new yacht? Your goals will shape your strategy, and your risk tolerance will determine how much you're willing to lose in pursuit of those goals. Creating a clear, comprehensive trading strategy is not about predicting the market's every move. Instead, it's about setting a course you can steer confidently even when the market gets a little choppy. With a clear strategy in place, you're ready to make your first trade. Making your first trade can be both exciting and nerve-wracking. It's the moment where theory meets practice, where all your research and strategic planning come to fruition. But let's break it down to make it a little less daunting. First, you'll need to choose a brokerage. This is the platform where you'll conduct your trading. Consider factors like transaction fees, user-friendly interface, and customer support. Some popular options include E*Trade, TD Ameritrade, and Robinhood, but there are numerous others out there. Do your homework and pick the one that suits your needs best. Once you've chosen your brokerage, you're ready to decide how many shares to buy. This will depend on your budget and risk tolerance. If you're new to trading, it might be wise to start small until you get the hang of things. Remember, investing is not about making a quick buck. It's about growing your wealth over time. Next, it's time to place your buy order. This is as simple as logging into your brokerage account, searching for the stock you want to buy, entering the number of shares, and clicking buy. You can choose to place a market order, which buys the stock at its current price, or a limit order, which only buys the stock when it reaches a certain price. But the work doesn't stop there. Monitoring your investments is crucial. Keep a close eye on your stocks and the wider market trends. If one of your stocks isn't performing as expected, don't panic. The stock market is known for its volatility. It's important to stay calm and make adjustments as necessary. You might want to sell a stock if it's consistently underperforming, or buy more of a stock if it's doing particularly well. Just remember to stick to your strategy and not let emotions dictate your decisions. Congratulations, you've just made your first trade. Remember, stock trading is a journey, not a destination. Let's quickly recap what we've covered today. We started by understanding the basics of the stock market. It's not just about buying low and selling high, but also about knowing the market trends, the language, and the rules of the game. Next, we delved into the realm of researching and analyzing stocks. We learned about the importance of financial statements, industry trends, and market news. It's not just about the numbers, but also about the story behind those numbers. Then, we discussed developing a trading strategy. We emphasized the significance of setting clear goals, managing risks, and staying disciplined. Remember, it's not a sprint, but a marathon. Finally, we walked through the process of making your first trade. Remember, it's okay to start small and learn from your mistakes. With the right knowledge and a bit of practice, you can play the stock market and potentially achieve financial success. Happy trading!